Hello and welcome to our channel. In today's video, we are going to understand if retail traders should trade in futures and options or not. Both futures and options are derivative products. The main difference between futures and options is that the buyer of the futures contract has a right and is also obligated to pay the underlying asset on the particular date in the future. It is a leverage product where the traders get unlimited profits or losses depending on the movement of prices. Whereas the buyer of the options contract has the right but does not have the obligation to buy the underlying asset on the particular date. For this, the buyer has to pay a premium to the seller. For example, we might have used payback or reward coupons or cards. The coupon or card by itself does not accumulate points. However, the points are added only when you purchase goods from your debit or credit card. Hope you've understood the concept clearly. There are four different types of derivatives that can easily be traded in the Indian stock market. Each derivative is different from the other and consists of varying contract conditions and risk factor. The four different types of derivatives are as follows: forwards, futures, options, and swaps. With a sudden influx of knowledge and interest in the stock markets, many retail investors in India are trying to move towards challenging shores like F&O trading. However, futures and options are far more complex as compared to equity investing, and without understanding the nuances of this investing or trading, one should not enter the space. F&O are derivative contracts and are based on an underlying asset's price. Therefore, these require a good understanding of the price movements of underlying assets and effectively the ability to predict future price movements. Without sufficient knowledge of F&O pricing of underlying assets and the fundamentals of the asset, one must avoid venturing into it. Here, wheat is the underlying asset which the seller, that is farmer, sells to the buyer, that is the bread maker, at a premium of 40 rupees per kg in the future. So, the bread maker will make a payment of 20,000 rupees to the farmer after 3 months. In the meantime, if the cost increases more than 40 rupees, the farmer will still be obligated to sell the wheat at 40 rupees only. Again, if the cost decreases below 40 rupees, still the bread maker will have to make the payment of 40 rupees per kg. Unlike cash trades or regular stock trading, one does not need a Demat account for dealing in futures and options. This is because options trades are more like contracts and are only valid until the expiry period. The risk in cash markets is generally limited to the investment made. However, in F&O, the losses can be higher than the investments made. This is because market volatility can easily erode the entire capital amount even with one wrong trade. Therefore, one must know potential and personal risk taking ability before getting into futures trading. Many new entrants in the F&O market prefer to trade in options because of their limited risk factor. The risks here is limited only to the premium paid. Since F&O trading can involve significant losses and if not planned and executed correctly, using stop losses is of utmost importance. An investor or trader must ensure to protect his or her profits, capital and profits, and that is possible only if losses are defined in each trade. Irrespective of how expects the price of the underlying asset to move, the stop loss levels must be predefined and adhered to always. Being mindful of the costs involved in F&O can allow an investor to know the actual return on investment or net profits. Although the brokerage and other associated costs of F&O trading may seem lower in percentage terms, they can be significant due to constant churn of transactions. Investors must also check the exact brokerage fees, GST, and statutory charges like stamp duty, STT, etc., applicable on F&O trades. Futures trading cannot be done on all stocks that are listed on the stock exchanges. One can trade in futures only for some of the stocks that are eligible. These are selected using multiple criteria such as liquidity, volume, etc. SEBI has allowed approximately 175 stocks that can be traded through derivative contracts. During volatile market conditions, the margins on future contracts can rise significantly. While many believe that futures are better than cash market trades as one can buy on margins, these margins can easily trap an investor. During tough market conditions, one may either need to add more margins or exit the existing positions. Let's look at the advantages. Lock in prices. If you have a buyer and seller willing to trade a stock at a future price as on today, hence you are in a way locking your price today of what could be the price in the future. Hedge against unfavorable movements in rates. Since you are no astrologer to predict the future prices, things can go your way or negatively impact the way you think. This is when hedging reduces your risk by taking an opposite position against the original position undertaken. Mitigate risks. Anything in life will have associated risks. Hence, you have to take calculated risks either to accept, avoid, transfer, or reduce the risk. These pluses can often come for a limited cost. Derivatives also can often be purchased on margins, which means traders use borrowed funds to purchase them. This makes them even less expensive. The disadvantages now. Derivatives are difficult to value because they are based on the price of another asset. The risks for OTC derivatives include counterparty risks that are difficult to predict or value. Most derivatives are also sensitive to the following: changes the amount of time to expiration. If anyone who trades in options would notice that the premiums are high during the opening weeks of the expiry, and then as the time elapses, the premium shrinks due to theta loss. Secondly, the cost of holding the underlying asset. In the derivatives market for futures and forwards, cost of carry is a component of the calculation for the future price as notated below. The cost of carry associated with a physical commodity generally involves expenses tied to all of the storage costs an investor forgoes over a period of time, including things like cost of physical inventory storage, insurance, and any potential losses from obsolescence. Before getting into F&O trading, one must keep the above mentioned points in mind and ensure to measure the risk levels against personal risk appetite and adhere to a certain trading principle. Trading in futures and options is nothing like rocket science that is normally made out to be. A proper understanding will surely help you make better use of these innovative financial products. With this, we conclude the video. Thanks for watching. Until then.